Welcome to the Wealth Continuum, where we decode the markets and uncover the opportunities hiding in plain sight. If you're serious about building lasting wealth through strategic investing, hit that subscribe button and turn on notifications. What I'm about to reveal is happening right now and could position you ahead of one of the most explosive moves in the commodities sector. Let's dive in. It's January 16th, 2026. Today is the day. While most investors are distracted by the latest tech stock headlines, something extraordinary is unfolding in the silver market at this very moment. And I need to walk you through it because what happens in the next few hours could change everything. Here's what happened yesterday. At 9:45 a.m. Eastern, silver got hammered. A brutal 4% drop in minutes. The kind of move designed to shake out weak hands and trigger panic selling. Mainstream media called it a natural cooling period. But here's what they're not telling you. While silver bled 4%, the mining companies that actually extract this metal barely flinched. The Silver Miners ETF opened down just 1.4%. And by midday, it had recovered almost all of that loss. Let me be clear, that's not weakness. That's relative strength. That's the market signaling something the financial media won't touch. Today is the third Friday of January, monthly options expiration day. For those who understand these markets, this is when billions in derivative positions either print money or explode. And there's a specific reason the miners haven't moved yet. They're being artificially suppressed to protect massive institutional short positions. Here's my thesis. Silver miners are being deliberately held down for today's options expiration, despite silver trading near $91. But the mathematical reality of their profitability can't be suppressed forever, and today is when we find out if the dam breaks. Let me explain the concept that unlocks this entire opportunity. Operating leverage is the magnifying glass of profitability. When the price of what you sell explodes but your costs stay relatively fixed, profits don't just increase, they multiply exponentially. Here's a simple example. Imagine a lemonade stand where production costs are $1 per cup, and you sell it for $1.10. Your profit is 10 cents. Now imagine a heat wave hits and demand surges. The price jumps to $10 per cup, but your costs remain 1. Your profit isn't 10 cents anymore, it is $9. That's a 9,000% increase in profit from a 900% price increase. This is exactly what's happening with silver miners right now. Most silver mining companies have all-in sustaining costs around $30 per ounce. That's everything. Labor, diesel, equipment, permits, taxes. When silver was at $35, these companies were surviving with razor-thin 14% margins. But now, with silver at $91, let's run the numbers. At $35 silver, $35.30, $35 14% margin. At $91 silver, $91.30, $91 stir 67% margin. The profitability increased by nearly 5 times, yet the stock prices remained flat, pinned down, disconnected from reality. This is the anomaly. This is the opportunity. I know what you're thinking. If this is so obvious, why isn't everyone talking about it? Let me address the main counterarguments. Objection 1, rising costs. Yes, inflation has increased diesel, labor, and equipment costs. But even if all-in sustaining costs rose from $30 to $40, a 33% increase, silver has risen 157% from $35 to $91. The margin expansion is undeniable and visible in quarterly earnings reports. These companies are generating record free cash flow. Objection 2, jurisdictional risk. The fear that governments will tax away windfall profits is exactly why these stocks are cheap. It's already priced in. And here's the reality. Governments move slowly. By the time new tax legislation passes, stocks will have already doubled or tripled. That's the opportunity window. Objection 3, declining ore. Grades. Yes, mines are getting deeper and ore quality is declining over time, but this is a slow-moving long-term trend. It does not explain why miners are priced for 30 silver when spot is at 91. The current valuation gap is about short-term suppression, not long-term geology. Here's my battle plan for today, January 16th. Signal 1, the silver-to-sil ratio. As we speak, if miners start moving faster than silver itself, that's the signal the suppression is breaking. Relative strength is the first indicator of major trend reversal. Signal 2, the $91.50 level. This is where we closed yesterday. If silver holds above this through today's peak volatility window, around 1 p.m. Eastern, I believe the floor is real and the path of least resistance is higher. Signal 3, recovery pattern. That perfect V-shaped bounce we saw yesterday morning after the 9:45 dump, that's not retail buying. That's institutional money defending a floor. If we see that pattern repeat today, it confirms smart money is accumulating while everyone else panics. The next few hours will be critical. You're going to see volatility. You're going to see whipsaws. You're going to see moves that don't make sense on the surface, but make perfect sense when you understand the options positioning. Here's what I am watching for. A massive fight at the $90 and $95 strike prices. There are billions of dollars in notional exposure at these levels. If silver holds above them into the close today, a lot of institutional players are going to be in serious pain. And if the banks start to lose control of the $90 level, expect some creative intervention, margin hikes, convenient news headlines about Chinese demand or Indian import duties. They have tools, they will use them. Because if these miners start to gap up, if the decoupling becomes obvious, all those call options go in the money and trigger a gamma squeeze, a multi-billion-dollar forced buying event that feeds on itself. This isn't unprecedented. During the 2010-2011 precious metals bull market, we saw an identical pattern. Silver went parabolic while miners lagged for months. Then, seemingly overnight, they exploded 200% to 300% in weeks. Some junior miners went up 1,000%. The miners always lag. Institutions are slow to reposition. Analysts are slow to upgrade. Retail investors don't even know these stocks exist until the move is halfway over. But when the catch-up happens, it happens violently, all at once. The financial media operates on narrative, not math. Right now, the dominant narrative is that inflation is under control, the Fed is winning, and precious metals are irrelevant. That narrative is sticky. By the time it shifts and CNBC starts covering this story, the easy money will be gone. Additionally, many large institutions are trapped in legacy short positions that made sense at $20 silver, but are bleeding them dry at $91. These shorts create their own gravity, and when they're finally forced to cover, the upside becomes explosive. Here's what most investors miss about silver miners. They're not just commodity plays. They are asymmetric leverage opportunities disguised as boring industrial stocks. Think about it this way. If you buy physical silver at $91 and it goes to $120, you make a 32% return. Solid, but not life-changing. But if you buy a miner trading at current suppressed valuations and silver hits $120, that miner could easily double or triple because of the operating leverage we discussed earlier. This is the kind of setup where small position sizes can have outsized impacts on your portfolio. You don't need to bet the farm. A 5 to 10% allocation to quality miners in this environment could potentially deliver returns that move the needle on your entire net worth. And the risk-reward ratio. When stocks are priced for $30 silver, but the metal is at $91, your downside is limited by the fact that we'd need a catastrophic collapse for silver to fall back to those levels, while your upside is virtually unlimited if the suppression breaks. The beauty of operating leverage is that it works in both directions, which is why timing matters. Getting in before the market reprices these companies is the difference between making 50% and making 300%. And today's OPEX could be the catalyst that forces that repricing to begin. Let me give you another historical example that's eerily similar to what we're seeing today. In early 2016, silver was trading around $14, having been beaten down for years. The miners were absolutely hated. Nobody wanted to touch them. Then, between January and July 2016, silver rallied to $21, a 50% move. You know what the miners did during that same period? Some of them went up 200%, 300%, even 500%. First Majestic Silver went from $4 to over $20. Hecla Mining more than tripled. These weren't penny stocks or speculative juniors. These were established producers with real operations. And the move happened in just 6 months. The pattern was identical to what we're seeing now, a prolonged period of suppression, then a sudden recognition of the disconnect between metal prices and equity valuations, followed by an explosive catch-up rally. The difference between 2016 and today, silver is at $91 now versus $21 then. The margin expansion potential is even more dramatic. If we see a similar recognition event where the market suddenly wakes up to the profitability of these companies, the moves could be even more extreme than what we saw 8 years ago. Let's talk about what the big players are actually doing, because this is where it gets really interesting. While retail investors were panicking during yesterday's 4% silver dump, institutional money was doing something very different. The recovery pattern we saw, that perfect V-shaped bounce, wasn't random. That's the signature of large block buying. When you see silver drop 4%, but miners only drop 1.4%, and then recover within an hour, that's not mom and pop investors clicking buy buttons. That's algorithmic institutional buying with very specific price targets. These are players with access to order flow data, vault inventories, and COMEX positioning that retail doesn't see, and they're defending a floor. Here's what's particularly telling. The short interest on major miners like Hecla Mining is at multi-year highs. Think about that for a second. Silver is at $91. These companies are printing record free cash flow and short interest is increasing. That's not rational risk management. That's desperation. That's institutions trapped in legacy positions, doubling down, praying the price comes back down. And history shows us what happens when shorts get squeezed in a rising market. The covering becomes a forced buying event that accelerates the move higher. Now, let's zoom out to the fundamental picture, because the operating leverage story only works if silver itself continues higher. And the supply-demand dynamics right now are unprecedented. According to the Silver Institute's latest data, we're in a structural deficit. Global industrial demand, from solar panels, electronics, electric vehicles, 5G infrastructure, is consuming more silver than the world produces. In 2024, the deficit was approximately 150 million ounces. That's not a small number. That's roughly 15% of annual mine production that had to come from above-ground stockpiles. And those stockpiles are finite. Eventually, the math catches up. When you're consuming more than you produce, year after year, prices have to rise to either stimulate new supply or destroy demand. But here's the problem. Silver doesn't respond to price signals the way other commodities do. You can't just flip a switch and open a new silver mine. It takes 7-10 years from discovery to production. The permitting alone can take half a decade. So even if silver went to $150 tomorrow, we wouldn't see meaningful new supply until the 2030s. This creates a perfect storm for sustained higher prices. And while silver stays elevated, these mining companies are generating cash flow that far exceeds their capital requirements. They're not just surviving, they're thriving. Yet the stock prices haven't caught up because of the suppression mechanism we're watching play out today. Let me be completely transparent about the risks here, because I'm not in the business of pumping hopium. There are legitimate scenarios where this thesis doesn't play out the way I expect. Risk number 1, coordinated intervention. The banks and market makers have tools at their disposal. We could see a sudden margin hike from the COMEX, making it more expensive to hold long positions. We could see technical difficulties on major trading platforms right at the crucial moment. We've seen it before during volatile periods. If they're desperate enough to protect their short positions, they'll use every trick in the book. Risk number 2, macro reversal. If we get an unexpected deflationary shock, maybe a credit crisis, a major bank failure, or a sudden liquidity crunch, all risk assets get hit, including miners. In 2008, gold miners got destroyed alongside everything else, even though gold itself held up relatively well. Liquidity events don't discriminate. When funds need to raise cash, they sell what they can, not necessarily what they should. Risk number 3, geopolitical black swan. Many silver miners operate in jurisdictions that could see sudden political instability. A nationalization in Mexico, new windfall taxes in Peru, environmental shutdowns in Argentina. These are tail risks that could impact individual companies. This is why diversification through an ETF makes more sense than betting on a single miner. But here's the thing about risk management. You don't avoid opportunities because risks exist. You size your positions appropriately. You set stop losses. You have a plan for multiple scenarios. The potential reward here, 200% to 300% moves if the thesis plays out, more than justifies taking calculated risk with proper position sizing. Let me walk you through what I'm expecting in the 3 most likely scenarios after today as OPEX concludes. Scenario 1, the breakout, 40% probability. Silver closes today above $92. Miners show continued relative strength. Over the weekend, institutional algorithms rebalance and Monday opens with a gap up. We see volume surge, short covering accelerates, and the catch-up rally begins in earnest. In this scenario, I'd expect SIL to test its 2025 highs within 2 to 3 weeks, potentially delivering 50 to 80% returns from current levels. Scenario 2, the grind higher, 35% probability. Silver holds the $90 level but doesn't break out dramatically. Miners continue to show relative strength, but the move is gradual rather than explosive. This is actually the most sustainable scenario long-term. It gives institutions time to reposit ion without triggering a panic. The catch-up happens over months instead of weeks, but the ultimate destination is the same, fair value pricing based on current profitability. Scenario 3, the fake-out, 25% probability. Silver breaks below $88, triggering stop losses and creating a flush lower. In this scenario, I'm standing aside, waiting for stabilization. But even here, if the fundamental supply deficit remains intact, it becomes a better entry point rather than a thesis breaker. The operating leverage doesn't disappear just because the price pulls back temporarily. The key is knowing which scenario we're in by Monday's close and adjusting accordingly. That's the difference between gambling and strategic positioning. We're in a unique environment. Equities near all-time highs while gold tops $4,000 and silver exceeds $90. This tells us investors are hedging, buying stocks from FOMO and metals from fear. This isn't sustainable. The scenario I'm positioning for is one where both continue higher, because the underlying currency is being debased. In that world, Miners become the ultimate asymmetric bet. They're leveraged to the metal price, but also function as equities, catching the bid from both sides. Here's what I'm doing, though this is not financial advice, just my personal approach after years in these markets. If SIL finishes today flat or green while silver stays red, I'm adding to miner positions. That confirms the decoupling is real and the suppression is breaking. As we head into the final hours of OPEX, that's when the real fireworks happen. That's when market makers pin the price to maximum pain. That's when you see wild swings, fake outs, and head fakes. If silver drops below $85 today during OPEX chaos, I'm standing aside. I won't catch a falling knife. I'll wait for Monday's tape to show the true direction. Once the dust settles, I'm going to review where we closed, the volume, and the options open interest that expired in the money versus out of the money. Then I'll make my decision for Monday, because the real move, the sustainable move, happens after OPEX, when the hedges come off and the underlying trend can reassert itself. I'm looking for the catch-up rally to test 2025 highs in the mining ETF. The math suggests these stocks should triple just to reach fair value based on historical margins and current silver prices. Today, January 16th, is options expiration day. It's happening right now. This is the day when the paper market meets physical reality. It's when billions in derivative positions get settled and the suppression mechanism faces its greatest test. Silver is at $91. Miners are priced as if we're still in a $30 environment. The mathematical disconnect is undeniable. The operating leverage is explosive, and the setup is as compelling as any I've seen in 12 years of trading these markets. The numbers don't lie, but prices do. And today, we're finding out which one the market believes. This is the kind of opportunity the wealth continuum was built to uncover, the asymmetric plays that emerge when markets misprice reality. If you found this analysis valuable, subscribe now so you don't miss my follow-up analysis on how today played out. Hit the like button, drop a comment with your thoughts on what you're seeing in silver miners today, and share this with anyone who needs to understand what's really happening in the precious metals sector. I'll be monitoring this in real time throughout the day. If we see the breakout I'm expecting, I'll be back with an immediate update after the close. Until then, stay sharp, stay disciplined, and remember, wealth isn't built by following the crowd. It's built by seeing opportunities before they become obvious. This is the Wealth Continuum. I'll see you in the next one.